Unmasking the lifelong risks of investing in real estate. Is real estate a good investment? Human beings have felt the allure of land or property since time immemorial. Today, availability of loans and affordability has made it easier for people to own property. As a result, real estate, which used to be an asset class for the classes, is now an asset class for the masses. Not surprisingly, we are convinced that this is the best financial asset class of all times. This is the reason why investment in housing is disproportionately higher amongst the middle class. The middle class seldom invests in stock markets, mutual funds, or even life insurance. Also, most of the people that own real estate do not buy it outright. They buy it with borrowed money or home loans. The interest is quite high, and most of their lives are spent repaying the loan. There is a term called house poor. The many ways being house poor can hurt you. A person who spends a large proportion of his or her total income on home ownership, including loan payments, property tax, maintenance, and utilities, have to lead a below par lifestyle. Being house poor may mean this can prevent us from doing the things we want in life and can slow our ability to reach financial freedom by years or even decades. If a lot of our money goes towards home related expenses, this means we have less money for other things in our life. Our finances may make us too afraid to reach our dream. We will be forced to think before we change our job. We will not be able to retire when we want to. Reasons why real estate isn't really the best investment. The pros and cons of owning real estate. In real estate, there are more cons than pros, which will block our money and prevent us from investing in better, safer, or even riskier options with literally a very small maintenance fee. Real estate can be a good investment if the value increases over time, but we need to put down a significant amount of money upfront to begin real estate investing. In real estate, we cannot predict for certain whether in future we will earn a good amount of profit or not. That's not to mention the constant high maintenance costs we'll be accountable for. Leverage in real estate. Leverage in real estate means the use of borrowed capital to fund our real estate investments. The less the amount we invest our own money than borrowed money, the more is the leverage. All these payments are being made with the assumption that real estate prices will rise. The expected return is not a guaranteed return though. It needs to be understood that the price doesn't need to fall in order for the investors to lose money. Even if the price stays stagnant, investors have already lost a huge chunk of their savings, which they paid out in the form of interest. Leverage increases an investor's expected return, but it also increases the amount of risk they take on. No diversification in real estate. Investing in real estate is the definition of putting all our eggs in one basket, instead of having a balanced portfolio which protects the investors in the event of a downturn. Real estate consumes most of the savings of the middle class. Liquidity is not guaranteed. Real estate is the most illiquid investment. Liquidity describes the degree to which an asset can be quickly bought or sold in the market at a price. One of the most basic factors that makes an investment is our ability to control when we can buy it and sell it to maximize our investment return. Since our home is the personal residence, we will have very little control over the purchase and sale from an investment perspective. We'll purchase the house when it is needed for shelter purposes and sell it only when it no longer serves that purpose. Real estate is probably the only illiquid investment that is held by the middle class, where the money is there in the form of an asset, but we can do nothing with it. Sorry. In downtimes, it becomes even more difficult, and sellers often have to wait for quite some time before they can obtain cash from the sale of their property. There are many liquidity challenges in real estate. It could be a buyer's market when we need urgent cash, and yet it might not be easy to find a buyer. An urgent sale usually fetches much less than the true value of the asset. Both harmony and liquidity can diminish. Real estate cannot be easily divided between the members of the next generation. Property conflicts account for about 66% of the cases pending in India's civil courts. Three-quarters of all cases heard by India's top court are linked to the same subject. Costs which are hidden. The real estate market is also very opaque. In the case of other financial instruments, the listed prices are the exact same thing as the transaction prices. However, in the case of real estate, with abnormally high transaction costs, the listed prices are very different than the rates at which the transactions actually take place. Real estate has a lot of operational costs. When some families buy a home, they don't think about the total cost of home ownership. Buying a home can easily lead us to being even more house poor than we originally thought if we don't do enough research. What long-term, permanent, either visible and some hidden expenses are involved in buying a home? Some of the costs include, one has to include everything from down payment from our own pocket, loan payment, broker's commission, registration fees, annual maintenance, property tax, society annual payments, utility bills, furnishing costs through the years, any other changes, and on sale of property, capital gains tax. Long-term capital gains on sale of real estate are taxed at 20% plus a cess of 3% if the sale fulfills certain conditions. If we sell a property that was gifted to us or that we inherited, we will still be liable to pay capital gains tax on it. And if we have inheritance tax in the future, we can add that to the overall expense. This also contributes to the illiquidity point. The illusion of rental income. Many of us make the mistake of considering just the absolute cash that comes in as our rental income from our rented properties. We can see from the image the rate of return is only 2.67%. When we consider all the hidden expenses, and this return is much lower than the rate of inflation and lower than the returns offered by other investments. Now compare the rental income to the amount we spent to buy the house or apartment. We spent on interest payment, GST, society charges, repairs, property taxes, and income tax on rent, to say the least. Instead, we must check the rental yield. Rental yield is the annual rate of rental return which an investor can earn from his invested capital in a property. Sorry. What remains in our hand is the net rental yield, which is about half of the rent amount. Net rental yield is inversely proportional to the property cost, which means that the lower the property value, the higher the rental returns. This further implies that investment in affordable or mid-segment projects can fetch us higher returns than high-ticket purchases. However, the probability for the same depends upon factors such as project type, location, amenities offered, level of maintenance, and the developer's brand. Moreover, in countries where the rental yield is higher, the interest rates tend to be lower, which means that the opportunity cost of renting is not very high. This is precisely the opposite of India's situation, where the opportunity cost tends to be higher because of comparatively lower rentals. Real estate rental yield tends to be lower than the financial portfolio's growth rate. The tenant is the ultimate winner. Despite the high amounts, the rental yield across the major cities in India is one of the lowest in the world. The net rental yield in India is in the range of 2 to 3%, which is lower than investing in any other financial instrument and almost twice lower than the rate of inflation. And as the inflation goes up, the bank interest rates on loans also goes up, and the landlord ends up losing further on his rental property, which he assumed would be an additional source of income and an asset. In fact, it turns into the biggest illiquid liability for the landlord. In Mumbai, rental yield on commercial properties is 7 to 9%, whereas for residential property it is around 1.5 to 2%. The rental yield in India is quite less as compared to other Asian countries that are around 3.5 to 4%, and the European countries where the average yield hovers between 4.5% to 5%. Even though rent may be going up, but compared to the average rate of inflation of 7.5% between 1960 to 2021, is it really going up? Rental income rarely outperforms inflation. Switzerland, with 68% of the population, and Germany, 64% of the population, are firmly rental societies, where around two-thirds of the population don't own their homes. And that was the case in 2020 and 2021. More than 50% people in India live in their own houses, while almost 30% live on rent and 13% in their parents' house, reveal the latest Royal Institution of Chartered Surveyors Knight Frank report. Financial investments may be better options for generating higher post-tax returns and liquidity. Effect of inflation on real estate. We are able to afford a home because we have done a good study based on our earnings today. As the years progress, due to inflation, the value of property will appreciate. All the expenses related to real estate will also appreciate with inflation, such as maintenance charges, property taxes, along with rising inflation. Each day lost with non-occupancy will cost tenfolds than what it costs today. Newer real estate projects are adopting a different approach by requiring upfront maintenance deposits for an extended period, sorry, typically 10 years, instead of the traditional periodic charges. However, this can be disadvantageous for buyers as they will need to make an initial lump sum payment for which he will have to pay interest on the borrowings. Considering the current inflation trend, these funds are likely to deplete sooner than expected, necessitating additional maintenance deposits. Looking ahead to retirement, our variable salary will be replaced by a fixed pension. Over time, the property will age and require maintenance and repairs, which will be based on future value. As wages increase by approximately 10% per year, the wages of daily wage laborers will also rise. Currently, we might be paying around 350 to 600 rupees per day for daily wage laborer. However, in 20 or 30 years post-retirement, labor costs alone could reach as high as 2,000 to 3,000 per day or even more. In addition to material costs. Will we be able to afford it? And once we are retired, it will be too late to repair the 30 to 40 years of damage. Having a home is not a fill it, shut it, forget it scenario. The bottom line is that buying a house as soon as we can is an old advice. There are several financial pitfalls there are to owning a home. We will have a home of our dreams, but a retirement that we will not be what one had dreamt of. For that reason, real estate is the most overrated asset in history. And our biggest asset can turn into a lifelong nightmare and the biggest liability unless we are planned for it. May the force of diversification across various asset classes to manage risk effectively be with you. Please go through the description for the sources for this presentation. I've shared the link to my next presentation, How Millennials Are Changing the Future of Property Ownership, at the end of this presentation. And do not forget to check out the playlist for more presentations. If there is something to gain and nothing to lose by asking, by all means ask. Thank you for taking the time to watch this presentation. I sincerely appreciate it. Namaste.